The morning of April 5, 1933, began with frost on the windows of private vault companies across Lower Manhattan. Bank vaults had stayed open past midnight to accommodate the queues of men in wool overcoats, carrying leather satchels and briefcases. They were not making deposits. They were demanding physical delivery. By 4 o'clock that afternoon, Franklin Roosevelt had signed Executive Order 6102. The order required every American to surrender all gold coins, bullion, and gold certificates to the Federal Reserve by May 1st. The penalty for noncompliance was a $10,000 fine or up to 10 years in federal prison. Safe deposit boxes were sealed by Treasury agents. Banks became inspection checkpoints. The asset these men had buried under floorboards and locked in downtown vaults was not common stock. It was not real estate. It was the one thing the government needed to confiscate before the devaluation could begin. 80 years later, the mechanics have evolved, but the sequence remains identical. In March 2013, depositors in Cyprus woke to find their accounts frozen and ATM withdrawal limits set at €60 per day. The government did not begin by seizing factories or nationalizing shipping lines. It began by trapping liquidity. In February 2022, Canadian authorities froze the bank accounts and crypto wallets of protesters without judicial warrants or criminal convictions. The infrastructure for asset seizure now operates in real time. The perimeter closes faster than it did in 1933. But the target is always the same. The pattern repeats because the underlying incentive never changes. When a financial system approaches insolvency, the state faces a binary choice. It can allow capital to flee into assets outside the banking system, draining institutional liquidity dry. Or it can seal the exits, forcing purchasing power to remain inside the perimeter where it can be harvested through inflation, mandatory bond purchases, or direct bail. The first asset attacked is always the bearer instrument that competes with the government's monopoly on monetary distress. It is always the bridge out. This dynamic operates according to what we can term the crisis liquidity hierarchy. In stable conditions, all assets compete freely based on yield and risk. When payment systems freeze and credit markets seize, the hierarchy collapses into a single imperative. The government must prevent the conversion of bank liabilities into non-bank stores of value. Gold functioned as this escape route for centuries. Cash under a mattress served this function until recently. Cryptocurrency serves this function today. The specific instrument changes. The threat it poses to trapped capital remains constant. In 1933, the United States government did not target gold because it was speculative or unproductive. Gold was targeted because it was the alternative. When Roosevelt signed Executive Order 6102, the United States was technically still on the gold standard. Citizens could still demand specie for their paper dollars. This represented a direct claim on the Treasury's reserves. As banks failed and deflation accelerated, intelligent holders recognized that the official dollar price of $20.67 per ounce could not hold. They converted deposits into coin and bullion. This drainage threatened the remaining banking system's collateral base. The confiscation was not merely punitive, it was preparatory. Once private gold was criminalized, the government could devalue the dollar against gold from $20.67 to $35 per ounce. This was a 41% devaluation accomplished overnight. Those who had surrendered their gold at the official rate saw their purchasing power halved. Those who had hidden it faced prison if they spent it. The exit had been sealed in mind. The United States was not unique in this behavior. The United Kingdom banned the private holding of gold bullion in 1966, as Harold Wilson's government faced a run on the pound. Australia implemented similar restrictions in 1959 during a balance of payments crisis. India restricted gold imports and private holdings during its 1963 currency crisis. In each case, the sequence was identical. First, capital controls on the asset that functioned as money outside the banking system. Then devaluation or default. Then, and only then, the reopening of markets for less threatening assets like equities or real estate. The mechanism is straightforward but often obscured by financial terminology. A banking crisis is fundamentally a shortage of trusted collateral. When depositors lose faith in the solvency of the institutional system, they seek to convert digital claims into physical assets that carry no counterparty risk. Gold requires no bank to validate its weight. Cash requires no blockchain confirmation. These assets represent sovereignty over liquidity. For a government facing collapse, this sovereignty is treason against the monetary system. By criminalizing or freezing these holdings, the state accomplishes two objectives simultaneously. It prevents the drainage of capital from the institutional pipeline, and it acquires real assets to back its own deteriorating paper. This channel operates as financial forensics. We study past system failures not to predict specific dates, but to understand what survives when the structure itself becomes predatory. The evidence from 1933, 1966, and 2013 is unambiguous. Institutions do not fail gracefully. They fail by converting private property into emergency public liquidity at the precise moment when alternatives are most needed. This distinction matters because not all assets are attacked with equal ferocity. Real estate may collapse in nominal value, but it is rarely confiscated outright during the initial crisis phase. The property remains taxable and visible. Stocks may halt trading for days or weeks, but they are not typically seized by Treasury departments. Corporate bonds may default, but they do not carry criminal penalties for possession. These assets suffer from economic downturns and counterparty failures. They do not threaten the government's monopoly on emergency funding. Therefore, they are allowed to suffer privately. The attack is reserved for the monetary escape valves. Today, the physical gold of 1933 has been supplemented by new forms of bearer liquidity. Cash itself has become the primary target. Sweden and the European Central Bank have systematically eliminated high-denomination notes, making physical storage cumbersome and suspicious. India's 2016 demonetization removed 86% of circulating currency overnight, forcing holders to deposit physical cash into digital accounts or face total loss. Argentina has banned citizens from purchasing dollars while simultaneously prosecuting those who trade cryptocurrency. The asset class evolves. The pattern remains invariant. When the system faces stress, the first target is always the instrument that allows citizens to operate outside the official ledger. Current infrastructure suggests this pattern is accelerating rather than diminishing. Central bank digital currencies represent the architectural endpoint of this historical impulse. Programmable money allows for preemptive restrictions on velocity, holding limits, and geographical boundaries. The sanctions architecture deployed against Russia in 2022 demonstrated that Western governments can freeze sovereign reserves and seize oligarch assets within hours. These were not acts of war in the traditional sense. They were liquidity attacks executed through administrative toggles. They revealed that the infrastructure for asset seizure no longer requires safe deposit box drills or treasury agents. It requires only a line of code and a server farm. Understanding this framework changes how one interprets the concept of diversification. Geographic diversification matters because jurisdictions compete for capital until they harmonize in crisis. Physical possession matters because digital records are administrative variables, not property rights. The distinction between insured deposits and bearer assets becomes critical when insurance funds face simultaneous claims across an entire banking sector. The synthesis is not optimistic, it is structural. The first asset attacked will never be the speculative bubble or the overvalued equity. It will always be the bridge out. Return to the vaults of 1933. Those men in wool coats were not criminals or hoarders. They were readers of financial history. They recognized that the crisis had already begun in the silent ledger entries of insolvent banks. Their attempt to retrieve gold was an attempt to step outside the perimeter before it closed. The government understood this perfectly. It had to confiscate the exits before it could devalue the currency. The safe deposit boxes remained sealed until the new price of gold was fixed at $35 an ounce. Only then were they opened, empty.